But first rates, it is not 70,000. I thought I would say 70,000, but it is not 70,000. The breadth, I think, is looking amazingly strong. That, I think, is the real big talking point right now. The breadth is looking amazingly strong. In terms of the market setup, Adani group of stocks, Tata Steel, metals, it's, when you got a breadth which is 1:13, you don't have too much of scope of getting things wrong. So it's a universal rising tide phenomenon, which clearly is at play in terms of the market factor. We spoke about Ola. Is the Ola proposed IPO having an impact on EV companies, whether it's TVS, Bajaj, Atul Auto, to some extent I would say Hero Motor, but Hero Motor Corp is not such a large player in EV. So TVS, no impact. Bajaj, big impact. Atul Auto, let's look at it. Hero Motor Corp 29. Well, to be fair, Atul Auto is into 3-wheelers, so the impact may not be that large, but the impact in terms of price move, I think, is there. Where is Paytm? And let's look at OMC stocks. We did not discuss them at length, but oil is down, rupees, dollar is down, which means oil marketing companies could be passing on a price cut soon, and that is surely having an impact on the stock price. 18-hour impact, thank you sir. 3% down for some of the stocks in terms of the OMCs, and BPCL, I think, is taking the biggest crunch, so to speak, or a knockout blow of about 3.5%. Aisha?
Okay, just looking at some of the other names, let's see what Infosys and DLF both are up to, because there have been CFO resignations at both. Infi, actually, it's a more sedate move there. It's down less than 1%, and DLF is still holding up, mildly in the positive, in fact, still hovering around that 670 mark. Mankind Pharma, there is that block deal that just happened. 500 crore rupees is supposedly, to change hands. 1835 on Mankind as we speak right now. Spandana on the sidelines of their analysts. They've indicated that they're targeting an AUM size of 28,000 crore rupees by FY28. 3% of a gap up coming in for Spandana Spurti. There's JNK Bank, wherein the ET9 newsbreak has been confirmed. There's a QIP launch. They're seeing strong demand. REC, they're entering into that 200 million euro loan agreement with German banks, so look out for that as well. And Dixon, after that order win from Lenovo, these are a bunch of stocks which are going to be in focus. REC mildly higher. Dixon, of course, has gapped up by about almost 4% as we speak right now. Reports indicating that there could be a QIP for Sterling and Wilson as well. They're looking to raise about 1,500 crore rupees, so look out for that too. That's another stock which is going to be in focus. And then Sun Pharma, wherein we understand that the offer price to acquire remaining outstanding shares of Taro has been raised to now $43 per share. Flat for Sun Pharma as we speak right now, and that block deal on Mankind has happened, 4.5% lower. It's almost 3.6% of equity, which is traded in a bunch as we speak right now. Aster DM is the other one in focus. Newspaper reports are indicating that they're looking to sell stake in their India business, and PE firms have already sent non-binding bids. Aster DM Healthcare holding up almost 3% as we speak right now. Kunal, any first trades you're tempted to punch in?
Yeah, I think Bajaj Finance is something which looks attractive as a buy on dips. I think the stock has corrected some 250 odd points from the, I think 1 week or 2 week back swing high. So I think the risk reward to enter the stock at current levels could be attractive.
Okay, Rudra, let's get in your take. Looking at the headline numbers on the screen right now, the fact that we are sustaining and it is a mild positive bias, that small caps as well are holding out. What do you make of the trade setup, and what is your first trade?
See, for me, today's up move, will it hold or not, is a very crucial thing, because SGX was indicating somewhere at around 65 points gap up. Now we are seeing only 25 point on Nifty. We are seeing some time-wise consolidation, medium to longer time frame, very bullish on market. For short term, one has to wait out before you enter at index level. Stock specific, I like Motherson Sumi, might be at current market price or any dips. I will look at opportunity to buy Motherson Sumi. Stock can definitely move towards levels of 110, 115. One can buy it positionally, available also in futures.
Okay, at record highs actually right now for the frontline index at 21,026. When it comes to the large caps, yes, names like HDFC Life, Hindalco, JSW Steel, Tata Steel, Nikonj, and even ITC are holding out.
Yeah, it's not like a gangbuster move in large cap stocks, but this steady consolidation, they're taking their time consolidating, next trigger comes in, flows come in, and that's how it's like a staircase kind of a move. What you don't want to see, an explosive move. You go up in a jiffy, makes you good, if you look at the screen, but for the health of the market, that's never a great sign. Harsha Padya joins us, CIO with Kotak AMC. Let's take our conversation forward. Harsha, this has perhaps been nothing short of a dream year, right? I mean, we may have seen bigger years like this in the COVID comeback, but in terms of the real wealth creation, this really has been a great year. What should be the strategy as we step into 2024 now?
Good morning, Nikunj. Clearly, fundamentals, flows, as well as sentiments have all turned positive. So clearly, we seem to be in a very, very bullish mood in the very short term. But at the same time, we should also remember that rising tide takes up valuations of almost every stock, irrespective of fundamentals. So to that extent, one should keep an eye on the fundamentals as well and the relative valuations. As far as we are concerned, we continue to believe that in Indian equities, if you stay invested for next 3-5 years, you are definitely going to make reasonable returns. Probably if you are in large cap for next year, the risk reward will be more favorable, given that large cap valuations are more or less around the fair value of long-term range. As far as mid and small caps are concerned, they are definitely higher than long-term averages. So to that extent, the earnings delivery in that basket will be crucial for the valuation to sustain. Overall, within equities, we prefer a little bit of large caps at this point in time.
Okay. And within large caps, Harsha, morning firstly, where's the preference?
Clearly, there is no sector which is very, very attractive from a valuation perspective. But if you look at how short-term performance has been, how ownership has shifted, I think banking and financials could be one sector within large caps where there is relative valuation comfort. The sector has not done much. Probably NBFCs have done a little better than banks, and especially private banks have not done much. So we believe that this is one sector where risk reward is favorable for medium-term to long-term investors. And similarly, pharma and healthcare could be another segment where there are still some stocks which are reasonable in terms of valuations within the large cap segment.
Harsha, for banks to do well, the economy has to do well. While the capex cycle is strong, but if I look at data points, what is happening to FMCG sales, what is happening to unsecured loan as a category after RBI's diktat, how essentially rural economy is moving, there is a slowdown which is happening. So how will banks do well if one end of the economy is not growing?
Clearly, there are still issues on the consumption side. Maybe some bit of deficient monsoon adverse impact will be compensated by pre-election focus on rural areas. We still have to wait and see. But the unsecured consumer credit and the issues surrounding that that you mentioned, probably it's more prominent in the fintechs and those who are in the NBFC segment, not so much in the banks, I would say. And clearly, even with all of this, the credit growth is still in healthy mid-teens kind of a number. And there are no asset quality issues. The capital is adequate for further growth. So all in all, I think on a relative basis, still banking, especially the private banking segment, seems to be better placed compared to many other areas in the market, which have run up quite a bit in terms of valuations. And also, there are similar concerns on growth even in some of those areas.
Harsha, morning. We were talking with some corporates as well within the FMCG sector, and they did allude to the fact that there is an improvement in volume growth and that rural is going to be a key focus area for most of these companies. How are you looking at the overall macroeconomic backdrop with respect to the rate of inflation, the GDP growth impacting some of these consumption-related FMCG companies?
See, in terms of inflation, I think it's definitely under control. We have seen quite a bit of moderation in the past few quarters, and even going ahead, barring some uneven food inflation numbers that may come up temporarily, overall inflation trajectory seems to be well in control. Look at the commodities, especially crude, which has fallen from about $95 to a barrel to about $75 a barrel. So I do not believe that inflation is likely to become a spoil sport in the very short term. And in terms of growth, we are already growing at about 7% plus, and likely that we will continue to grow at similar levels over the next few years as well. So broadly, from a macroeconomic perspective, there are no big risks at this point of time. The only thing that one needs to keep in mind is the fact that monsoon has been deficient this year. We may not see a big impact this time around, but if the next monsoon is going to be worse than the usual trend, then definitely the rural consumption trends, which are tepid right now, can take longer for revival. So that's something that will be in front of us maybe 6 months down the line. Similarly, another key thing that we need to watch out, while the entire market has been in a bullish mood and lapping up all the QIPs and whatever is on offer, if you look at the first half of this financial year, nearly 150,000 crores of worth of paper has come from promoters and private equity funds, including the IPOs. And the secondary out of this is about 115,000 crores, which is very, very large number compared to the usual trend that we used to see all the time. So the question is, when retail investors and everyone else is very, very bullish on the markets, why are the insiders selling so much of their own equity at these valuations? So that's something that one needs to keep in mind.
Harsha, the other pocket, and you can't really ignore that, is the power financiers, and especially come to light after IREDA's listing recently, an issue price of 32, and I think the stock is around 80 plus already today. And the kind of valuation catch-up that now PFC and REC are doing with a newly listed entity like IREDA. Is the market right in giving and subscribing them the valuation that they're currently quoting at, the entire trio?
For a large part of last 12 to 15 years was kind of very, very difficult period for power financials. And definitely market had ignored this entire segment. So to that extent, the valuations had fallen to very, very low levels as compared to many of the other financing businesses. In the recent past, with the growth coming back into the power sector and also with people recognizing the valuation differential, we have seen quite a bit of catch-up. So from here on, I do not believe that there could be a large amount of re-rating of these stocks. I think these could probably still move, but more in line with the growth that they will exhibit rather than due to rating.
All right, guys, IREDA, I mean, sometimes law of gravity also gets challenged. And that's that factor which is really at play in terms of where the stock is moving. A new buyer in the town seems to be there. Let's look at the intraday graph of that stock in a sense just to establish that, well, what can I say, 35 rupees, was sub 40 rupees was the offer price, and now it is almost at 100 rupees, 17% higher for IREDA. What a move it's been for IREDA. So Harsha, where are you looking at booking profits now? I mean, in this kind of a move.
Nikunj, not so much sectorally, but definitely we are moving some money from, let's say, overheated mid and small cap segment and putting it to large caps wherever the mandates allow us to do that. And in case of mid and small cap strategies, we have been at the minimum level of the mandated level, that is 65% of mid caps and 65% of small caps respectively. And also we hold a little cash. We never use cash as a tool to manage our performance, but in this kind of a market, it's always prudent to keep some amount of cash, and if we see some unforeseen corrections, and if we like some of those stocks, then probably we could build that position. So that's been our strategy. No big sectoral calls at this point of time.
Sure. So where do you think, Harsha, there is that froth build up, or segments within mid and small caps are topping out?
In many areas, but clearly the lower the market cap, the lower the liquidity. There has been unprecedented moves, and that's where we are less comfortable, I would say. But if you speak in terms of sectoral or subsegment related valuation risk, probably defense, railways, all these areas have seen significant re-rating in the recent times. Definitely from a medium to long term perspective, there is a lot of growth, there is a lot of money to be made. But one cannot extrapolate the kind of moves that we have seen in the past 6 or 9 months and expect that a similar thing would continue with no volatility going forward. So that's where on a relative basis, probably one needs to be a little careful and not expect the short-term performance to continue again for the next few quarters.
Okay, and you were talking a little bit about how there has been quite a bit of action in the primary markets, and if the year is anything to go by, that has really reflected a lot of conviction in a lot of these companies coming public. Your take on some of the recent IPOs, the valuations they command. For instance, we were talking about IREDA and it on the brink of hitting 100. Your overall outlook on the IPO market?
Without making any stock-specific comment, I would say that definitely the valuations that you see at the initial stages of listing cannot be extrapolated into once the lock-in opens or once the medium-term. So to that extent, irrespective of the stock that gets listed, one should reevaluate at what valuations one was comfortable earlier at the IPO stage and what it is trading at currently, and whether anything has changed in the meantime to warrant such a different kind of a valuation. So I would say that we have not avoided IPOs. We have been participating, but definitely it seems similar to what we do on the secondary side, that every company we analyze based on growth and valuations. And in case of IPOs, we are even more careful because these are companies where we have not seen much of a track record or how they have behaved in the past cycle, etc. And to that extent, we have to be a little more careful in selecting new set of companies.
Well, Harsha, I really appreciate your time and thank you for joining us. The stock which has, in a sense, surprised everybody after listing is IREDA. No one saw this kind of a move post-listing coming. And why are markets excited? What is the way forward for this business cycle per se? And how exactly the sector would be immune to what is happening to the real world in terms of interest rate? Pradeep Kumar Das, CMD of IREDA, joins us. Pradeep, good morning. Thank you for joining us. 100 rupees for IREDA. Did you actually see that coming in less than 1 month of your IPO?
Good morning, Nikunj. Thank you. Thanks for inviting me to speak. First of all, we are quite happy that the investor is having that kind of trust, what we had envisaged. But certainly about the market moves and fundamental sentiment and perception. Our fundamentals are pretty strong. We have already proven in last 3.5 years that hockey stick kind of growth, which is required for industry. Being the largest pure play green finance company in the country, and working since 36 years. So, and more people are aware of this renewable sector, and more and more interest they put in, because it is not just for economic. There are two drivers for this. One is economic driver in any case when you are doing the lending, but that environment factor, that is also quite important. People are doing business, people are investing, but apart from the economic gain, this kind of social environment contribution, what we have done in last 36 years, that perhaps people are recognizing.
Yeah, absolutely. And, already at 100, who knows, it'll be 150 very soon. But let's keep the stock price aside, Mr. Das. The market of late is very enthused about the launch of your retail division. Tell me, what is the opportunity that the retail division is going to present here?
See, retail broadly, we have focused into two parts. That is, one is Kusum, PM Kusum scheme, that is solarizing the agricultural sector. That is having roughly an opportunity of 1 lakh crores of financing, which generally, see, if you see the Indian GDP growth contribution, agriculture plays the most key factor. So far, what IREDA had been doing, IREDA had been playing a key role to developing the sector, maturizing, and then others used to come in and play. Though the PM Kusum scheme was announced in 2019, but still it was not getting momentum, maybe a couple of years, COVID kind of thing. And now gradually the other agencies like NABARD and others, those who are largely into agricultural sector financing, they have also taken a lot of changes in their approach. But largely, since IREDA is the sole agency to develop the sector through financing, almost singly 2.5 decades or even around 3 decades. So therefore, it was quite a lot expectation from the sector, as well as the gap in understanding or gap in that commanding knowledge what IREDA is having vis-a-vis others, probably that is. And since we have been focusing on largely project development and developing the sector, and there is a huge gap despite 3 years of government announcement. our ministry has put a thrust on us also, as well as we being the responsible lender in this space, we have to work out how to make it bankable and how to bring all these farmers into the mainstream RE development in the country. See, ultimately, they are our feeders. So we have to ensure that the pie of the development, the pie of the gain, or pie of the contribution with respect to economic as well as social environment impact, these farmers are also contributing and participating.
Mr. Das, I want to spend some more time here. I want to understand, A, how the dispersals are going to work. The nature of borrowers, like you said, is going to be largely farmers. What about the yields on these loans, the ticket sizes, and would the loans be secured or unsecured? How is it going to really shape up in your balance sheet?
See, if we're talking about NIM, if you see March 23, the NIM of HFCs, diversified, gold loan, and MFIs, and all, if you see, 2.8 in the range of HFC, and diversified 7.9, and gold loan 9.9, and MFI is 10 plus. But if you take the industry average, it is coming to 5.42. If you look at the IREDA, it is 3.2. That means we are slightly lower as far as this, because we focused on developing the sector, not on playing on the margin. Second, ROA, if you look at HFC 2 and diversified 2.9, gold loan 4.8, and MFI is 3.7, and industry 2.5, IREDA is 1.98. But along with the economic PA, we have the sustainable and ability to sustain that kind of growth of 36 years and last 3 years of a hockey stick approach. And if you see what is required, why this is not becoming backable, because agriculture lands are not considered for collateral. Perhaps, if required, government may intervene. If required, we can go for a slight policy realignment kind of thing in order to capture it. See, we have not been doing retail at all. Now, this is the requirement of the sector and the requirement of the economy. So therefore, being the most experienced and expert in the industry, we need to come forward what we have already done in the past. One retail segment, that is to e-rickshawalas. We have already done a year back, 1.5 years back. We brought in a small NBFC in the name of finance, and we have lended them. And what is the outcome, exact outcome I can tell you. The rate which was charged to those rickshawalas, which was 28 to 34, it has come down to just half of it, around 17.76.
Right. Mr. Das, your core business essentially is in area of alternate energy, whether it is solar, whether it is ethanol. The minute you get into farm loans, sir, that's a very different chain. And giving money to farmers involves a different kind of due diligence. It involves a different kind of a risk profile adjustment. And historically, farm loan waiver is been an issue for everybody. So would you be, I mean, you are walking on a path where you know that while the social need is great, but this whole move into retail may not be a very gratifying shareholder experience.
See, if you do existing our loan portfolio of around 47,000 of September, around 50 crore we have given towards these rickshawalas. So what is the percentage in that? And what kind of impact it is having? See, we are now planning to have a retail division. Already in PM Kusum, 58 crore we have sanctioned, but we have gone for a aggregator mode. See, what we will be doing, we are not going to lend directly to farmers, for sure, because we do not have that kind of design and structure in our organization. What we are going to do will impact our expertise in the due diligence, and will bring in the small NBFCs and MFIs, those who are having the regional presence, strong regional presence and having good track records. So it is a kind of handholding approach, and it will be a win-win situation. Our objective is, we are not going to, like this e-rickshaw, we have not gone to any e-rickshaw directly. We have brought in the NBFC, we have given a line of credit, they are doing, they were otherwise also doing. The rate was quite high. So that kind of thought we are having, that if we do not address this, probably the gap of Kusum funding will continue. So we being a responsible agency as well as extended arm, single arm of MNRE, who is primary movers of development of RE in the country. So we have to come in, do a kind of handholding approach. And there is risk, no doubt about it. We'll have the risk mitigation plan in place, and we'll do deep down study, and we'll work out the economics also. Since we are a listed company, we have to ensure that our investors' wealth is also intact and further sustainable growth is there.
Sure. You know, that's exactly the concern right now, Mr. Das, because your asset quality has been pristine so far. And now with the entry into retail division, the street is wondering whether anything could change. How would you ensure asset quality is not impacted? Could you go on record to say that asset quality is going to be maintained?
First of all, we have already done this since more than a year. We want to now put in a focus and more professional approach, giving a focused and dedicated effort. So we'll not be compromising with our asset quality for sure, because that is our strength. The kind of corporate governance what we do and give, and already given in last 3.5 years, that has already put a stamp in the corporate governance for any kind of CPSE in the country as of now. We'll continue to sustain that kind of corporate governance, asset quality, and discipline within the organization. What I'm trying to tell, we share our expertise. First of all, there is a lot of perception gap with respect to RE and RE financing. That perception gap is to be mitigated. And there is a fair amount of perception gap with respect to private sector financing also. If you see, look at our book of September, 77% is private sector book. Despite that, we are having a 1.65 net NPA. And our cumulative write-off in last 36 years, just 203 crore against a total finance of 1,07,000 crore of, if you take September data. So we'll continue to maintain that asset quality. And since we are listed now, our actions, our decisions, it is always subject to scrutiny and questions. So we have to maintain that kind of discipline and more responsiveness also.
No, with respect to your asset quality as well, there will be no compromising. Mr. Das, morning. What about the retail division? Because, I know you spoke of that. I want to understand over the next 5 years, what could the contribution look like?
See, as I told, Kusum is giving around 1 lakh crores of business. And if you see in e-mobility space also, which I have talked about e-rickshaws, we have also funded for this middle class kind of consumers, e-cars, which is prominently moving in NCR in particular, also to some extent in Bangalore. And this kind of segment was not taken attention by any banker or any NBFC prior to our giving. Post our giving, bank and other NBFC are also coming forward. But despite that, there is not that kind of speed of encouragement what we have sustained in this. So there is a now fragmented market, particularly significant to B2C, but in e-mobility space. Now, if we need to address their concern and challenges, then we need to have a dedicated division or department, or if required, we may have a separate subsidiary for that also. So that our accountability, our governance can be well accounted in separate entity. This is in a very nascent stage. Since 1 year we have already done, we have tested, tried and trusted. So these 3 tests we have passed. Now we have decided to have a dedicated division. So we'll see what kind of market response we are getting. And as I told you, we'll not be compromising with our asset quality and corporate governance. When you go to retail, it is slightly complicated and difficult. But we have known and proven track record of handling complicated and complex RE development in the country since 36 years. Only thing we did in wholesale, now it is retail. See, to manage wholesale and retail, the difference is you need to have more of techno-oriented business. And in order to ensure that kind of thing, we have already gone into full-fledged digital mode of project appraisal, application to disbursement, entire year. So also recovery. And we opened the office just 5-6 months back. We took a resolution ourselves that we'll make it a zero paper office. And so far we have been successful, and almost 97% of our paper consumption in that office has been reduced. So in the time to come, we'll further extend to the digitization, ease of doing business, and bring in more transparency, as well as accountability in place. That is what the major concern in a kind of retail financing.
Mr. Das, the street is really liking your shareholders and investors. Your stock is now at 101.
No, actually, if you ask me frankly, neither me or my team will look at profit figures or revenue figures. Similarly, I have already told them don't look at the share market because share market moves on our investors' expectation, sentiment, and respect for us. Now we have to maintain the kind of discipline what we have established in past 36 years, because the lending to largely private sector, lending to largely challenging and emerging and new technology, still sustaining this kind of asset quality that can come only and only with respect to discipline and best quality corporate governance. And we'll continue to focus on that. We'll not focus on stock market. And I'll request our investor, they should be careful while they're doing. And there must be, I think fair amount of awareness is getting built up with respect to renewable energy development, decarbonization, and energy transition in the country. Look at our Honorable Prime Minister in every international platform, be it G20 or be it COP program, he's focusing on this. So when Government of India, we being a Government of India entity, our objective is what? Whatever our government visions or gives us directions and decisions, we have to implement. So it is up to us as a corporate, how professionally, how qualitative way we are delivering it.
Right. Yeah, absolutely. One more question. Currently, NIMs are at 3.5%. Now, with the entry into the retail division, are you confident of maintaining the NIMs or even upping them in times to come?
Yeah, I can share only what we have done so far. In the retail, what we have financed, we have fair amount of NIM vis-a-vis our other vanilla RE.
Have to talk about the recent meeting which was also held to consider the Navratna status for your company in November end, as we understand. Give us an update. What was discussed? What's been the decision? Are you getting granted the Navratna status?
See, let us be very clear. We are a corporate of Government of India, and it is Government of India's process. We are meeting all the criteria I have already said earlier, and we have given, and the meeting was also held. And I believe that the meeting was quite satisfactory. So since it is Government of India's internal process and decision, I will not prefer to divulge what we have discussed there. We are hopeful that we'll be getting, the process will get completed soon.
Get the Navratna status, what changes for you?
See, first of all, the perception about the company, the qualitative conduct of the company will improve. See, we have submitted for this Schedule A and Navratna almost a year back, and we got upgraded from Schedule B to Schedule A in September 27th. And see, prior to that also, our rating was upgraded from AA plus to AAA stable. So the moment the rating improves, and this kind of qualitative improvement of PSU scale, so that is going to further boost the confidence of investor as well as the rating agencies. So anyway, in a lighter sense, when we have AAA stable, what further improvement on the rating will be? But yes, that will put a stamp on our continuous and consistent effort on enabling best quality numbers, as well as the way we are reaching to these best quality numbers through best quality corporate governance standards. So that will further improve, and by and large, once the perception of rating agency improves and investors improve, our lenders also, they are going to definitely come forward, because I have been pitching our global players, global lenders particularly, since last 3 years, 3.5 years, we are not drawing major line of credits despite having our line of sanction, despite paying the commitment charges, because those are not appearing to be true sense and spirit competitive when we look into the landed cost. So I have requested them, most of them, and since 3 decades they were with us, we have done fair amount of good relationship with them, and I have requested them not only to consider the landed cost comparison, then only they can justify it in true sense and spirit. It is a concessional funding in the true sense and spirit, the fastest RE development in the country. That is number one. Number two, we have also requested them, see how we have changed our governance. in government last 7-8 years or 9 years, the governance has completely been changed. The timeline, delivery, and committed action plans, those are done review monitoring. Today in government, we have a series of review monitoring by our ministry, by other ministries also, with respect to our actions. So when this kind of changes has happened, these lending agencies also should change their approach and methodology to do the appraisal. Otherwise, if it is done in the legacy way, how it was done earlier, by the time they complete any due diligence and appraisal of a project, by that time the project could have been set up in India. With a RE project at development takes quite lesser time vis-a-vis of fossil fuel projects.
Right, and I also wanted to understand from you, I mean, good to know that you're hopeful now of the Navratna status soon, but what about the competitive intensity in the space with the likes of REC, PFC also diversifying their loan book? What is the USP or the moat that you possess, or are you worried about any challenges due to competitive intensity?
See, there has never been any competition between us and REC with respect to emerging technology and all. With respect to established RE, plain vanilla RE, yes. And we have addressed that in last 3 years by maintaining a fair balance of around 60-40 ratio kind of thing, plain vanilla RE 60% and 40% emerging RE. So in this 40% emerging RE space, even to almost 20% is evolving RE. And in that space, we don't have any competition as such. I have a track record of establishing the emerging RE to establish RE in the past. So that kind of expectation again is there from us, from our developers and borrowers. And coming to this plain vanilla RE, since fair amount of de-risk effort has already been done and a huge amount of asymmetry of information has been reduced, so there will be a fair competition, not only PFC, REC, but also to the other banks, scheduled banks. So we are quite comfortable. And the kind of size of market what we have envisaged till 2030, roughly 32 lakh crores for your existing plain vanilla RE and emerging RE, and for the evolving RE another 14 lakh crores if you take the e-mobility and its related infra. 46 lakh crore is a huge demand, and our net worth is extremely small with respect to the kind of demand in the market. So even if we three complement each other, taking only 3 names, there are other NBFC in government space, Rail Finance and Foodco and others. Even they can also pitch in into their field, because energy transition is going to happen across all the sectors of the economy, not only in RE development, energy transition, decarbonization. So 3 space is going to be there. And 46 lakh crore is a huge amount. Even if you keep aside the evolving RE, take the 32 lakh crores till 2030, for this addition of 320 gigawatt of RE, which you require to reach 500 gigawatt by 2029, then we'll be requiring at least 24 lakh crore debt investment. And half of it, if you take REC, PFC, IREDA together, they complement each other. A fair amount of business is there. So we are quite comfortable, and I'm confident post adjusting our fully leveraging the net one fund, balance amount of joint lending we are going to do from these banks, IIFCL, PFC, REC, etc. We have already signed some 4 banks MOU and IIFCL also. And REC, PFC, we need not sign MOU. They are our entity only. Same honorable same minister, only say 2 different ministries, but we are working quite cohesively. And Honorable Itersons, I'm ex-REC, so I'm a REC person also. And since REC is subsidiary of PFC, so I'm PFC person also. So anything I speak, I'm responsible for all 3.
And all 3 are running up, aren't they? But great to have you on the show today, Mr. Das. Thank you so much for taking the time out and speaking with us.
Thank you very much.
Okay, that's IREDA in trade for you. Already hit that 101 plus mark, and from there we're currently skirting around 99.55 in trade. Lot of interesting takeaways from that chat, but let's revisit what the rest of the market as well is doing. It's a quiet day for the indexes. We've not done much. We were skirting around the 21K mark. Dixon is now holding up 5 after that tie-up with Lenovo that got announced. Z Holding up 3%. Indiabulls Housing, Hero Motocorp, Bandhan Bank are your big star performers today. Of course, besides IREDA, which we just flagged off. We'll take a very quick break on that note. Lots more lined up on the other side.
G. Madhukar Reddy, Managing Director and CEO of MedPlus, joins us now. Let's understand how things are moving for the entire retail pharma industry. Is there a slowdown there? Is competition intensified? And now that most of the online websites are getting very profit conscious, what does that mean for a company which has got omni-channel presence? Good morning. Always nice to have you back on ET Now. When we spoke to you last versus now, there seems to be a price discipline which has come on, which really has come to fore, at least for some of the online retail pharmacy companies. How exactly have the dynamics changed for the online industry, and how is that impacting an omni-channel company like yours?
Yeah, as you said earlier, they're all looking for profits right now, or at least they're looking to lose less money, I would say. So yes, there has been some, I would say, a dampening down of the promotional aspects of pharma retailing. But, as I've said in the past, the overall share of the online retail is a really a small portion of the overall business. I mean, it's less than 3 to 4%. In some cities in which it is concentrated, it could be as high as 5 or 6%, but I don't think it's much more than that. Our competition, I would say, the place from where we at least take our business is usually from the smaller independent retailers and all. And I don't think there's been any let up on discounting or any kind of, I would say, focus on price in that sector. So for us, things have not really changed much. Our own strategy has changed, as you all know. We have launched our MedPlus brand of drugs at a 50 to 80% price off, and that's basically been gaining a lot of traction. And the other part of your question, which was, is there a slowdown? I don't think there's a slowdown right now. If there's anything, it's just a seasonal kind of thing. That's all.
Yeah, actually had some issues in terms of drug license suspension on your select subsidiaries. What exactly is that, and how does that affect you?
This has always been there. It is only that we have seen that the SEBI has changed the rules a little bit. Earlier, they would say if it is of material consequence, report it. Now they're saying irrespective of that, please report it. So unfortunately, when you have 4,000 odd stores and when there is so many different drug laws to actually comply to, there are situations in which once or twice you will see some suspensions here or there. It's just that some of them have been bunched together in the last few days, but otherwise it is really nothing different. I would say the reporting rules have changed more than the actual ground reality, or at least the situation.
We spoke to you last, you said that, look, you're getting into your own generic brands. And they, in a sense, would be pitted right against the current OTC brands. What's been the response so far?
I won't say OTC because we've actually launched 500 drugs, and these are, aimed at every single therapeutic category out there. We have drugs for diabetes, hypertension, cholesterol, and everything else out there. In fact, statins, gliptins, and all. So for us, it's a wide range of drugs. What we base it on is the fact that 80% of the drugs which we sell in our stores are all off patent. Large companies make it. And some of them they make in-house, and some of them they get it done by contract manufacturers. We have the size and capability to get this done ourselves. So so we have the full range of drugs for customers who come in and believe the MedPlus brand and who understand that we have the capability of making these at the same level of quality. They stand to gain a lot by actually buying from us.
What about the diagnostic business though, Mr. Reddy? What's the expansion plan there?
On the diagnostic business?
Yes.
So right now, Hyderabad is where we want to be. The size of Hyderabad is where we want to be. In that we have gained our size. 12 centers across the city and all. I think the overall investment for us was around 120 crores. Now for the next phase, where we want to go to the next 8 cities, and this will cover, let us say, roughly around 10 crores of the population of the country. We are waiting, actually. One of the things I'd say, we're waiting for a couple of things to fall in place before we take the next step. And part of it is the B2B traction, which we're looking at. As you know, we sell a subscription plan. What we have sold today is mainly in the B2C. We're looking to see if some B2B traction can happen.
Sure, because you're currently at an EBITDA loss, I believe. When is it that you're estimated to break even?
I'm hoping, see, the plan was for a national rollout, but gradual. We have, costs which are already there on the corporate side, and that's the reason why you're still seeing a EBITDA loss on the diagnostic side. Fact of the matter is, at the center level, almost everything which is more than 6 months is profitable. So for us, it is just a question of scale, and we're looking for the ideal time to actually go across the country. But yeah, it is nothing which is out of the ordinary. But I would say Q4 of this year, or latest by Q1 of next year, we should be breaking even.
You've entered into a business which is highly competitive, where the peak growth which was there post-COVID, that is behind us. It's a space which keeps on getting disrupted. Is it worth the extension for you? Because you are moving away from your core knitting, right?
So we look at ourselves as a health services business. We are basically there in the OPD side, while pharmacy is a very, very critical part of the overall out-of-hospital healthcare expense. Diagnostics also is a very critical part. We have that customer base. One of the reasons why we entered that place is because 60% of our sales come from people who continuously buy, who at least buy medicines for continuous therapy, like for thyroid disorders or diabetes or cholesterol. All these people need to get themselves checked on a continuous basis every quarter. So we had that base. That's why we went in. That's one. And by the way, our business is completely different from anything you've seen out there in the country at this point of time. It's hugely different from a Lalspath Labs and Metropolis, which are purely biochemistry and pathology and all. We actually have the full service. We have radiology as well as pathology and all. And it is also different from someone like Vijaya and Krishna and all, because our business is purely based on a subscription model. So by just taking 1,000 rupees subscription fee, 1,150 a subscription fee from a person, we're able to give a 75% discount for the full year on every single test. Hugely valuable. So we are seeing a great traction for this. It's just a question of scale. We see this as a brand new business model. We're not in competition with any of the guys who are existing out there.
Right. Okay. Great to then have you today on the show, Mr. Reddy. Thanks so much for taking the time out.
Thank you. Thanks, bye.
Okay, that's the word coming in from MedPlus Health Management. Let's now talk about Sheila Foam. We have with us Nilesh Mazumdar, the CEO at Sheila Foam, joining in on the show right now. Nilesh, hi, morning. Good to have you on the show. Give us a sense of how business has been in the previous quarter and how it's likely to be going forward.
Good morning, Aisha. Well, the festival season has been good for the industry. We've seen a good turnaround. The last 2 months has been, there has been uptake in the volumes. Consumers have started buying. There was a lull in this industry for a period of time, but things are now coming back.
When you say the festival season has been strong, any particular reason why festival season has been strong? What is the correlation I'm trying to understand here?
Yeah, so you see, any durables category that you see, Nikunj, in this country today has a correlation with the festivities. So, for example, during Diwali, a lot of home furnishing happens, and therefore it's the right point of time for people to change their furniture, and along with that, obviously, mattress also comes in. And that's how we see the correlation. And post the festival season, as the marriage season also then is an occasion for gifting, and people buy mattress when they are occupying a new house or after marriage moving into a new house. So there is that correlation that we see in this industry.
There has been a big upswing in the raw material cost. Now there is a mean reversion which is happening. If you have to give us a framework of raw material price where it stands for you, are they back in the comfortable zone for you?
Oh, yes. So we did have post the COVID period, TDI and polyol, there were significant rise in the prices, but things over the last couple of months now have come back to normalcy, and there is a stability that we are seeing out there.
Now, to understand the growth, what is the best benchmark for us to use? I mean, if one has to understand the growth for, let's say, the mattress or the foam industry or Sheila Foam, what is the external benchmark we should use? GDP growth, real estate cycle, what is a true benchmark?
See, we have honestly not been able to find a true correlation with real estate. Now, with GDP, obviously, most industries would have a correlation with GDP. So, anywhere between, say, 1.5 to 2 times the GDP growth rate is what we should be seeing. What we need to understand about the mattress as a category, Nikunj, is that mattress in terms of the priority of purchase in the consumer basket doesn't come right on top. It is not an essential purchase. So therefore, we have seen post, for example, the COVID period, when we saw a turnaround in the other industries, the mattress industry possibly lagged behind. It took a while. And now things seem to be coming back to normalcy. So if I were to correlate it, possibly with GDP, I would say 1.5 times of GDP is what I would be looking at.
Sectors have seen huge, change in terms of the unorganized become organized. The mattress industry was very largely dominated by unorganized players. You know that nukkad ka, gadda wala, if I may use the Hindi terminology. Yeah. Post GST implementation, where does that number stand?
So, you are absolutely right that this is still one industry where the so-called the local or the unorganized player is almost at about 55 to 60% of the industry. And there are a couple of reasons for it. You see, first of all, for any shift to happen from the unorganized to the organized sector, it is important that the brands which are there in the organized sector are able to communicate to the customer, be salient in the consumer's mind, both as a category as well as a brand, and able to offer reasons why the consumer should shift from the unorganized to organized. And that is something which I see as the biggest opportunity for the industry and for the category today, which is within the foam mattress space. The other big opportunity which is there is that, you see, today more than half the country still uses cotton mattress or dari or chaddars, and they have still not graduated to the modern mattress. And that's a huge opportunity that we have for the industry today. And if we are able to get the right product, the right pricing, and the right distribution to be able to cater to that, I think one sees a significant upside as far the future of the industry is concerned.
And in terms of the organized market share, where do you stand?
So between us and Kurlon, if we were to combine both the brands together, we will be at about 30%.
Now that the acquisition has already worked, how will you 30% market share, which means almost 1/3 of the organized market is with you. Is that good enough for you to command pricing power? Is that good enough for you to squeeze out the distribution channels and perhaps, kicking operating leverage?
Yeah, I think, you see, obviously there are, because of the scale that we get in, there is going to be a significant amount of back-end efficiencies which we will be able to get in our operations, number one. Number two, from the volume on the supply chain side, we will also be at the front end, be able to get some amount of leverage, which both the share and the volumes will be able to give to us. And last but not the least, we will have two very strong, powerful brands in our portfolio. And because of this, what happens is that today, any consumer in this country, when he or she is planning to buy a mattress, almost 90% will have either one or both the brands in the consideration set. So that's the power that both the brands actually give us when we have them in our portfolio.
The mattress market is growing because of replacement or new demand? And is there a concept of replacement? Because when you sell a mattress, there's a promise of good sleep, but there's a promise of longevity, 15 saal, 20 saal. So is there a replacement demand which kicks in?
Yeah, so you see, on an average, what we find in this country is that person changes a mattress in 8 to 10 years. And that is just not in India. Even in the developed countries, the replacement cycle is around of that period. So there is a replacement market, and then there is a new market, and the new market is slightly different out here. That one of the triggers for purchase actually happens when a person is shifting house, whether it is rental or whether one is buying a new house and moving into a new house. That becomes a big trigger for purchase of mattress also. So we see both being at play as far as this category is concerned.
It's great to have you on the show. Thanks, as always, for taking the time out and joining in. Going to take a quick break. Still flat for the indexes, not doing a whole lot, but at least on the futures, we're now at 21,100, by the way, and above the 21K mark even for the Nifty spot. Dixon, that's his star performer today. DRL as well is covering up yesterday's losses. HDFC Life, Bandhan Bank, persistent. It's a new set of winners today. We'll take a break. Be right back. We'll have the Gale management join in.